Having now explored how banks organise themselves to manage liquidity risk, it's time to turn our attention to one of the most important regulatory metrics in modern liquidity management, the Liquidity Coverage Ratio, or LCR for short. In this session, we'll deep dive into what the LCR is, why it's been created, how it's calculated, and how banks operate to meet and optimise this critical requirement. We'll look at the composition of high-quality liquid assets, how outflows and inflows are measured, and how assumptions work under stress. We'll also examine supervisory expectations in the UK and EU and discuss some of the challenges and strategies that banks use to manage LCR effectively. By the end of this session, you'll have a detailed understanding of how the LCR serves as a frontline defence in banking resilience, and what it takes for a firm to manage this metric responsibly and strategically. Now, the Liquidity Coverage Ratio was introduced as part of the Basel III reforms, which were developed in response to the global financial crisis of 2007-2008. One of the biggest lessons learned from that crisis was that banks didn't hold sufficient liquid assets to survive a short-term funding shock. Banks assumed they could roll over short-term debt, tap wholesale markets, or sell assets easily. But when panic hit, those assumptions collapsed. Confidence evaporated, funding dried up, and the assets banks relied on for liquidity proved to be far less liquid than expected. Now, the LCR was designed to address exactly this kind of situation. Its purpose is to ensure that banks hold enough high-quality liquid assets, referred to as HQLA, to survive a 30-day period of severe but plausible stress. The idea is simple. If a bank experiences a sudden loss of funding or a sharp rise in cash outflows, it must be able to meet those needs using a reliable stock of assets that can be monetized quickly without relying on central bank intervention or assuming favorable market conditions. Now, the LCR is expressed as a ratio, and it looks like this. The stock of high-quality liquid assets divided by total net cash outflows over the next 30 calendar days must be equal to or greater than 100%. In other words, the bank must be able to meet its projected outflows in full using its own liquidity buffer for at least 1 month under stress. This gives regulators and markets confidence that the bank can handle immediate liquidity shocks. Now, let's break this down into 2 key components of the ratio. First, we have the numerator, the stock of high-quality liquid assets. HQLA are assets that can be easily and immediately converted into cash with little or no loss of value. They must be unencumbered, meaning they are not pledged as collateral elsewhere and are readily available for use in a crisis. Regulators divide HQLA into different levels based on their liquidity characteristics. Level 1 assets are the most liquid and carry no haircut in the LCR calculation. So these include cash, central bank reserves, and certain sovereign debt securities such as UK gilts, German bunds, and US treasuries. Now, these assets are considered universally liquid, even in severe stress, and form the core of most banks' buffers. Level 2 assets are split into 2 subcategories, Level 2A and Level 2B. Level 2A assets include certain government-guaranteed securities and highly rated covered bonds. They receive a haircut in the LCR calculation, typically 15%, and are subject to composition limits, meaning they cannot make up more than 40% of the total HQLA stock. Level 2B assets are even less liquid and include things like lower-rated corporate bonds and certain equities from major indices. Now, these receive higher haircuts, up to 50%, and are capped at 15% of the total buffer. Now, banks must constantly ensure that their HQLA portfolio meets these criteria. Assets must be legally and operationally available, and banks must demonstrate that they can convert them into cash at short notice. Some regulators conduct liquidity exercises or simulations to test whether assets classified as HQLA would actually be usable in practice. For example, the Bank of England may ask firms to demonstrate how they would monetize specific assets in a crisis scenario, including through repo operations or outright sales. Now let's look at the denominator. Total net cash outflows over the next 30 days. This is where the stress scenario comes into play. Regulators define a set of standardized assumptions about how different types of funding behave under stress. These assumptions are deliberately conservative. They're not forecasts, they're meant to model a severe situation in which clients withdraw funds, markets tighten, and credit lines are drawn down. Now, the bank must estimate its expected cash outflows and inflows over the next 30 calendar days. So outflows include retail and corporate deposit withdrawals, maturing wholesale funding, derivative collateral requirements, and committed credit facilities. Inflows include scheduled loan repayments, contractual cash receipts, and maturing investments. However, to prevent banks from relying too heavily on outflows, regulators cap the recognition of inflows at 75% of total outflows. So this ensures that banks always hold a buffer rather than depending on uncertain cash receipts. Now let's look more closely at some of the outflow assumptions. For retail deposits, regulators distinguish between insured and uninsured deposits, and between stable and less stable accounts. For example, insured deposits from a retail customer with a long-term relationship may be assigned an outflow rate of 3 or 5%. But large, uninsured corporate deposits may be assigned outflow rates of 20% or higher. Operational deposits, so those held for transactional purposes, receive more favourable treatment than non-operational deposits, which may be more flighty. Wholesale funding is generally assumed to roll off in full unless the bank can demonstrate that it has legally binding commitments for renewal. Undrawn committed credit facilities to corporates are assumed to be drawn down in part or in full, depending on the counterparty type. Derivative exposures are assumed to generate margin calls under stress. These assumptions reflect the kinds of behaviours that were observed during past crises. Clients draw down lines, counterparties ask for collateral, and maturing funding becomes harder to replace. Once all expected outflows and inflows are calculated and the appropriate haircuts and caps are applied, the result is the total net cash outflow number. This is then compared to the HQLA stock. If the HQLA stock is large enough to cover these net outflows, the bank's LCR is above 100%. If not, the bank is technically non-compliant and must take action to restore its position, either by raising more liquid assets or reducing outflows. Now, in normal times, banks are expected to maintain LCR above 100% at all times. But regulators recognise that buffers are there to be used. In a real crisis, supervisors may allow temporary breaches of the LCR, providing the bank has a credible plan to restore compliance. That's why the LCR is often supplemented by internal targets. So banks may aim for 110 or 120% under normal conditions, giving themselves headroom in case of shocks. Now, managing LCR day to day is a highly operational task. Treasury teams must monitor inflows and outflows constantly, adjust funding strategies, and rebalance the HQLA portfolio to meet regulatory and internal targets. You then have risk teams reviewing the underlying assumptions, conducting sensitivity analysis, and monitoring early warning indicators that might suggest increased outflows. For example, a drop in market confidence, increased media attention, or unusual client behaviour could all point to rising liquidity pressure. One of the key challenges in managing LCR is the balance between liquidity and profitability. Holding large amounts of high-quality liquid assets often comes at a cost. Now, these assets tend to yield less than loans or investments in higher-risk instruments. So there is often a natural tension between maximising returns and meeting LCR requirements. And this is where strategic decisions come into play. Banks must decide how much buffer to hold centrally versus in legal entities, which assets to include in the buffer, and how to fund them. Another challenge is the volatility of the ratio itself. Because outflows and inflows are recalculated daily, the LCR can change rapidly, especially in times of stress. A single corporate client moving a large deposit or a swing in derivative collateral can materially alter the bank's LCR. So this requires systems that can track changes in near real time and governance processes that allow for swift action when needed. From a regulatory perspective, LCR is a key supervisory tool. Authorities like the PRA and the ECB monitor LCR closely using daily or monthly returns submitted by banks. Now, these returns include detailed breakdowns of HQLA composition, outflow and inflow categories, and assumptions used. Supervisors use this data to assess the bank's resilience, identify trends, and spot emerging risks. They may challenge banks on the usability of their HQLA or ask for more conservative assumptions if market conditions deteriorate. In the UK, the PRA follows the guidelines set by the European Banking Authority, which apply across the EU and have been largely retained post-Brexit. Firms must report LCR at group level and for certain material subsidiaries. They must also produce liquidity metrics as part of their ILAP submission, which is reviewed annually as part of the Supervisory Review and Evaluation Process, or SREP for short. If a bank's LCR is deemed insufficient, supervisors may impose Pillar 2 liquidity add-ons or require remediation actions. Stress testing plays an important role here. Banks are expected to test the robustness of their LCR under different scenarios, not just the regulatory baseline. They may run internal scenarios involving idiosyncratic shocks, market-wide disruptions, or combinations of both. Now, these tests help identify weaknesses in the liquidity buffer or gaps in funding strategy. For example, a scenario might assume a loss of unsecured funding, a credit rating downgrade, and higher client withdrawals. The LCR is then recalculated to see how the buffer holds up. Beyond stress testing, firms also produce liquidity contingency plans. These plans outline how the bank would respond if the LCR fell below 100%. What assets would be monetised first? How would communications be managed with regulators, clients, and investors? Who would make key decisions? How would funding be replaced? These questions must be answered clearly with defined triggers, governance, and playbooks. Regulators review these plans and often simulate liquidity events to test them. A special consideration arises in cross-border banking groups. The LCR must be met not only at consolidated level, but also at material subsidiary level. Now, this can be challenging where liquidity is fragmented across jurisdictions and where ring-fencing rules limit intra-group transfers. Banks must plan their HQLA allocation accordingly, ensuring each legal entity can meet its own LCR, even if group-level liquidity is strong. Some banks use internal LCR metrics alongside the regulatory version. For example, they may apply more conservative outflow assumptions or include additional stress factors not required by regulation. Now, these internal metrics help management stay ahead of potential issues and maintain a strong liquidity culture. They also support strategic decision-making, such as launching new products, entering new markets, or managing balance sheet growth. To summarize, the liquidity coverage ratio is one of the cornerstones of modern liquidity regulation. It forces banks to hold a robust, reliable buffer of high-quality assets and to understand their cash flow dynamics under stress. It provides supervisors with a daily snapshot of resilience and ensures that short-term shocks do not turn into full-blown crises. But meeting the LCR is not just a compliance exercise. It requires active management, clear governance, and strategic thinking. The ratio must be embedded into business planning, product design, and risk management processes. In our next session, we'll turn to the other major liquidity metric, the net stable funding ratio. Now, while the LCR focuses on the next 30 days, the NSFR takes a longer-term view, ensuring that banks fund their assets with stable sources over a one-year horizon. Together, these two metrics form the backbone of global liquidity standards. In our next session, we'll explore how the NSFR works, what it measures, and how banks structure their balance sheets to comply with it without sacrificing profitability. I'll see you in the next session.